Yeah, I think we're back. Sorry about that. I'm not sure what happened. I've got you, Jim. Do we have our, we didn't lose our participants. But go ahead.
Okay. So yeah, I'm not sure where I got cut off, but one of the things that as a result of this act is that some of the people that might have decided to forego the option of borrowing under the PPP, there is still, both because the demand slowed down and some of the borrowers had repaid funds, there is over $100 billion still left, and the deadline is June 30th. So if there are any people out there that are still thinking about whether or not they should apply, there's still money left, which was kind of unexpected. And there are more flexibility now in terms of obtaining the forgiveness, participating in the payroll tax deferral, which Mike can talk about later, but that wasn't an option before. And so if there are people out there that decided to forego the potentially adding more debt, there's an option now to possibly think about going back in and getting one of these loans. So the key changes, and we have this little side-by-side here. The really big changes are, originally you had to squeeze your loan use proceeds into 8 weeks and spend 75% of that on payroll. It's now extended out to 24 weeks. So that's almost 6 months.
So Jim, when does that 24-week pay period, when does that 24-week period run from?
It still starts on the day that you received your money, but it runs for 24 weeks after that date. So you're basically—
so you don't have this big urgency to pay out a certain dollar amount that equals, so over 24 weeks, you just need to pay out 60% of the total amount. Now, if you use more than that for payroll, that's still part of your forgivable amount, right? Like a lot of people were already got the loans and were pushing to make payments before these amendments came out, right? So if you did that, can you still choose the 20, like let's say you're one of the businesses who was subject to shutdown and you weren't really quite ready, you went and got a loan in the first round, you weren't really quite ready to bring everybody back, and so you didn't do that, but you, like some people we were advising, well, go ahead and bring them back and, you know, redo your website and have them prepare for reopening. Some brought everybody back, some really couldn't justify bringing everybody back. So there's this, they can now, but so to the extent they brought people back and paid them, but didn't quite hit the 75% mark, they can just kind of continue on, and they have the 24 weeks instead of this 8 weeks, right?
Yeah, and if you got your loan before June 5th, you can pick. If you did everything in 8 weeks and you want to stick with that and get the certainty of your forgiveness, you can go ahead and use the 8-week original period. But if you didn't make the guidelines within those 8 weeks, you can extend it out now to 24 weeks. And again, you have quite a bit more flexibility in terms of how much you use on payroll and how much.
Is there any deadline as to when, so you can choose the 8-week period or the 24-week period? Is there a deadline on, you know, choosing which one you're going to use?
No, it's just when you file your application, you would just designate your covered period as being the 8-week or the 24-week, depending on which you choose to use.
Okay, and so then fill us in on this FTA reduction period. So what's this adjustment for FTE reduction?
Yeah, originally there were 2 different adjustments. One is for your workforce, your FTEs, and the other was for compensation. And both of those had a safe harbor adjustment to the adjustment, basically, that allowed you to restore your full workforce by June 30th and restore the full payroll compensation by June 30th. And then that adjustment would go away. those have now been extended to December 31st. So basically, if you meet the requirement of the 60% within the 24 weeks, if you have your FTEs, and they don't have to be the same people or even the same positions, just the same number of FTEs in your workforce by December 31st, and no one's salary
So
is
can an employer use the moment during that period that, you know, I mean, because workforces vary by their nature, right, without regard to the coronavirus anyway. So you're typically, you know, forget the coronavirus, you're hiring and you're firing. So can you now like choose the FTE that you have anytime this year, or how does that work?
That we're still waiting on some guidance. We did get some more guidance yesterday and this morning on how this is going to work, but whether you have to wait until the December 31st or whether you can pick a date, June 30th or sooner, to use for your safe harbor, that hasn't been clarified yet. So, but you do have 10 months after the end of your period to apply, so you should be able to, we should have final rules by the time people actually have to go in and apply.
But the intent, right, behind this is a recognition that not all employers are in a position to rehire everybody by June 30th. So if we ultimately get rules that are with the intent of the regulation, if you in good faith restore your employees and have the same number of FTEs that you did, what our hope is that you're going to, as long as you didn't like, you know, bump them up as of a certain date, because we don't want to have like, hey, I'm going to hire a bunch of people as of December 31, because now you have this 24-week period. But I mean, the general intent is that, hey, look, if you're making a good faith effort to restore your employees to the numbers, but we don't have clear absolute guidance, but we're sort of assuming that if at some point by the end of the year you hit the same number of FTEs you had both before and after, then you're going to improve your forgiveness ratio. Is that fair way to characterize it? And I know we have, you're all into the very technical rule, but I think that's the intent of the legislation. Right. So what's this adjustment for the compensation reduction based on February 15?
The original deal was that if someone had a cut in salary more than 25% and their original salary was less than $100,000 a year, there would be a dollar for dollar cut to your forgiveness. Based on that, the safe harbor allowed that to be restored by June 30th, and now again, that can be restored by December 31st, and there won't be a negative adjustment for that.
So, but is the total forgiveness calculated paid on your average monthly payroll? I mean, does that really make that big of a difference? Are we looking at an employee by employee adjustment in calculating the forgiveness, or are we looking at total payroll under 100 grand?
Well, your first.
So if I have 10 employees before, and they each make 50,000 just to keep it simple, and then we make an adjustment, we lay off 5, and now and we adjust salaries to 25,000 for the other 5, and then we rehire over the next year, we increase those that we cut to 25 by some amounts, but we make other hires. Are we looking at the total amount paid by payroll or a per person basis?
This final adjustment is per person, but if that position is eliminated, then it won't be penalized for the compensation reduction as well. So if you eliminate a position and then restore it by December 31st, then there won't be a negative consequence of that.
Okay, but what I want to be clear about is if I have an employee and I reduced their compensation. So let's say it's a 50,000 a year employee. I reduce their compensation by 20%. How does that affect me?
That does not affect you because it has to be more than 25%.
So it's my 30% or more adjustment. So if I adjusted somebody by 30% and then I increase their payback so their full adjustment is only 25% on average for the year, that's still okay?
Well, no, you would still have a little bit of negative consequence unless you restore them back all the way to their February 15th salary at 100%.
Okay. So anything else on this slide that you want to comment on, Jim?
Don't think so.
Okay. So then let's go on to the additional forgiveness flexibility.
Yeah, so another thing, in addition to spreading out the time frame and adjusting the percentages, they've also provided some additional kind of safe harbors here, where if the employer is offers the job back to the employee and they say no, it does have to be in writing. But if the employee says they don't want to come back, you won't be adversely affected by that. If you can show that you've reached out in good faith to hire similar people to your workforce before, and you weren't able to find the same type of workers, you won't be penalized for that. And if you can show that you're still restricted during the whole 24-week period, like if your restaurant is still subject to 50% capacity or whatever, depending on your state, you can show that that also is a reason for adjusting your FTEs or compensation, and you won't be penalized for that.
So Jim, and this could be a Matt Dunning question, so just let me know. But so if you employ, so we've heard this from a lot of employers, they're asking employees to come back to work, but there's some employees getting that $600 COVID payment and really happy to stay at home and do that. But if you offer them a return to employment and they don't come back, technically they're not eligible. Do employers have an obligation to let the Department of Labor know that they've made an offer?
Yes, I believe that's part of their reporting to the Department of Labor. And if you make the offer to return, and Matt can amplify this, my understanding is if you make the offer to return and they decline it, that is something that you report to the Department of Labor and can have an effect on their benefits.
That's correct. I think the process there would be the employer has the reporting obligation, but then the employee also is obligated to report whether they have work available and whether or not they have received compensation for work within the specific week when they're applying for unemployment. And the big issue there is, the State Department of Labor has issued, basically, warnings to applicants saying, you can't just stay home and continue to collect unemployment if you do have work available. So that is something that the state's definitely keeping an eye on because it's partially state money. I think that at the end of the day, I don't know how aggressive the state or federal government will be about this, but there's going to be fraud, there's going to be corruption in all of that, and people may have some unwelcome news in the future that they've inappropriately they were inappropriately paid benefits and they owe that money back.
And I have a question that kind of goes back to the last slide, Jim, but it's a really good question. And so that is, there's this 8-week period. So if you've managed to, use the a requisite amount towards payroll in 8 weeks and your entire amount is forgivable, which is the case for some of the people that we work with, then great. Elect the 8-week period, get your forgiveness application, and all is good. If you're not ready at the end of 8 weeks, is it I've got 8 weeks or 24 weeks? What if I've hit the right numbers at 12 weeks? Do I have to then wait till the end of 24 weeks and elect a 24-week period? Or can I apply for forgiveness at 12 weeks?
If you're going over 8 weeks, you do have to pick 24. But once you've used all the money and can demonstrate that you've met the 60% test, I believe that you can go ahead and apply for the forgiveness.
So the technical, it's not so much that there's no in between. There's an 8-week, you elect 8 or 24 weeks, but you might meet the criteria at the end of 12 weeks. You can go ahead and apply for forgiveness and get that in process. You don't have to wait till the end of 24 weeks to get your forgiveness application in, correct?
I believe that's correct, yes.
Okay.
They've put the applications out there and the instructions, and
yeah, and that's what I say. I got an email from one of our bankers, but what we've seen is different banks sending out different information, which just goes to the lack of clarity because the rules have been coming down and changing almost daily, right?
Sure.
Okay, So that's kind of, so then you had some just technical points here that we should mention.
Right, and this first one just actually came out today. We weren't clear on whether the $100,000 pro rata cap was going to be based on 8 weeks or 24 weeks. And basically they said that if you pick the 8-week period, then that's going to be an 8-week cap, which is $15,385. If you choose to go beyond the 8 weeks, then you can go all the way up to the $46,154 for any employee who's not an owner employee. They did put an additional limit, though, on owner employees, which is based on 2.5 months of their 2019 income. So if your 2019 income as an owner employee was more than 100,000, then you would be capped at the 20,833. If it was less than 100,000, then it's going to be 2.5 months worth of that 2019 income. So they're trying to prevent owner employees from just sort of loading up and paying themselves additional compensation. And also, if you have more than one business as an owner employee, you're going to be limited to that same cap across all of your different businesses. Those last 2 points were kind of important when people were trying to cram the money into 8 weeks. They're less important now over the 24 weeks, but you can adjust your covered period to align with your pay period if you're weekly or biweekly.
Okay, but what about the semi-monthly pay period? Because that's like biweekly at least is every 2 weeks, right? So, hey, they can do that within 8 weeks and just cover that. Same thing with weekly. But what about somebody on a semi-monthly? So you have kind of, depending on when that amount hits, that's kind of weird. We haven't seen any different guidance come for the semi-monthly, correct? And,
Right.
and that's where the 24-week election may help those employers.
Yeah, I think it's going to be less important in the 24-week frame, but yes, they've said that if you're semi-monthly, that they will not allow that adjustment, because you're basically the whole point is to line up the covered period with the pay period, and that won't work with semi-monthly anyway. So
the math.
So basically, yeah, this is how it plays out in practice. I mean, the loan amounts were based on 2.5 months of 2019 payroll. And so when we were looking at 75%, that was basically 8 weeks of payroll to be spent within 8 weeks. And that's because the idea was to sort of freeze your workforce in place and keep it going for the 8 weeks. Now that it's spread out over 24 weeks, you're looking at basically, because it's 60% and 24 weeks, you're looking at basically 6.5 weeks of your 2019 payroll spread out over 24 weeks. So there's quite a bit of different calculation. And so we sort of have these different strategic approaches on the next slide for those that need to sort of sort this through. One option would be to just plan for when your 24 weeks end and plan on bringing everyone back at least in those last few weeks of that to use up that 60% requirement. Or you now have the option to spread that out over a smaller workforce but a longer period of time. And again, as long as you get everyone back by December 31st, you won't be penalized for having a smaller workforce during the covered period. And then the final thing is they have allowed bonuses and hazard pay as compensation. And that's within that cap, the cap that I talked about, it's now up for non-owners up to the 41,000. But if you've been working with a skeleton crew to get you by, you can recognize that with bonuses or hazard pay as they define it, and that will count as forgivable compensation at the end of the 24 weeks. So those are some different options that people have the flexibility to consider now that they didn't have in the 8-week time frame.
So Jim, do the new rules change at all, like how you should use if you've gotten like the hardship loan program, which originally blew up and didn't have any kind of, finally came through. And so some people have both PPPs and the HDILs.
Mm-hmm.
And part of the rules were what you could use to pay what. So let's say that with this 24-week pay period that you can use 100% for payroll. And that's not going to exactly work out, right? Because you're still based on a percentage. But is there any strategy in terms of how you expend those funds that ought to be considered by employers that changes based on the new rules?
Yeah, that's a good thing you mentioned that. The disaster loans are now once again available. The SBA has reopened that application portal, which had been closed since April for non-agricultural businesses. So those are still a possibility for people that are affected beyond what they were able to cover with the PPP. And basically, it's not a forgivable loan, and it's the terms aren't quite as favorable, but you do have a longer period to pay it off. So, if you're going to use both, the main thing is that you not use the same expenses from both different loans. So, if you do have a lot of non-payroll costs, rent or debt obligations or things that you can't pay with the PPP and meet the requirements, the EIDL disaster loans are out there as a possibility.
So if I elect the 8-week period for the PPP because I never shut down, and so I have rent and all that, and the 8-week period applies, in week 9, can I use the hardship loan to pay rent? So it's a matter, the limitation is on paying the exact same expenses, not the same type of expenses. That's what I'm asking.
I believe, yes, if you've exhausted the payroll that you can pay with the PPP, I believe you can then use your disaster loan to start paying those payroll expenses, yeah.
Because that is, for a lot of businesses, their key expenses are, I mean, there's a lot of other expenses, but are covered by the PPP. So I'm just trying to get clear that if you elect that 8-week period, well, if you elect the 24-week period, that's a different answer. So there's still a lot of strategizing in terms of which period you should now select and how you should use the proceeds of those funds. And yes, by the way, if you didn't previously get a hardship loan that has been funded and it's 30 years with low payments at a reasonable interest rate, that just kind of helps you float through this while you see what happens to your particular business. So timeline, go ahead with that.
Yeah, the timeline is not as crucial now, except for those that are going to use elect the 8 weeks. But we will we do have a timeline and a checklist and a spreadsheet that we will going to be emailing out to everyone registered, along with the PowerPoint and the recording of the program. So so this is just sort of a overview. The main thing, you obviously you have to pick your 8 weeks or your 24, and then the way the new law is written is that you don't have to pay any principal, interest, or fees until you have had a determination of your forgiveness amount. And so that can extend now, since the 24 weeks will extend into the fall, it'll extend well into 2021, really, for most people. And then one of the things they've just come out with is an EZ application form for those who can certify that they haven't changed their FTEs or compensation, or for those who are solo independent contractors and sole proprietors, you can use the simplified form that just came out yesterday. And another thing that's in the new law is that you have 10 months at the end of the 24 weeks. So this can extend well into 2021 if you choose to, before you're obligated to actually apply and start having repayment obligations. And then there's a review process that will become relevant for people once they start applying. But
So Jim, if I elect the 8-week period, do I have 10 months from the end of the 8 weeks or 10 months from the end of 24? I'm just seeking clarification there.
It's the end of your covered period. So if you choose 8 weeks and you still have 10 months after the end of the 8 weeks, yeah.
Great, thank you. Anything else there on the timeline?
No, we'll send that out, in the email. Ember said, our tech administrator said she'll send that out to all the registered people, and the checklist, which is on the next one. And this is the stuff that you're going to need to pull together once you decide to put your application in. And it does, as I said on the previous slide, go to the lender first in most cases. So.
Great, and then we'll move on to the tax strategies. So some of the tax provisions of the act remain the same, but they've changed those to make them a little bit more available. And so Mike, you're going to speak a little bit to that. So let's start with the employer payroll taxes. And I'm just going to tell you ahead of time my question, and I'm assuming you're going to cover it, is, but what if they just kind of made this now, whereas can I retroactively reduce the amounts I'm paying to the taxes and treat that as like withholding that I could have withheld and not paid in previously, or is it only on a go-forward basis? And you don't have to answer that right away. I just want you to build that into your discussion of this rule.
Sure. So there's two other items, I guess, with respect to wages. One is there's this deferral of employment taxes, and then there's actually a credit for wages that an employer can take. So those are the two ones that I'm going to kind of hit on. The first one, the deferral. So employers, first thing is, what is it that you're able to defer? And it's only the 6.2% FICA that the employer is paying that's eligible for the deferral. It's not the whole Medicare, and it's certainly not with the withholding that you would otherwise be doing for your employees. So it's a 6.2% that you get to defer if you would like. The deferral period runs through December 31, 2020. So in answer to your question, Mary, it started, whatever the date was, in March 17th, and any wages that you paid after that, you could get the deferral on. Now, whether or not if you haven't deferred up to now because you were getting a PPP loan and you were prohibited from doing the deferral, if you can now retroactively. But
I mean, to be clear, I can now get a PPP loan and defer, right?
Yeah, to be clear, the rule used to be, prior to the recent changes, that if you were getting a PPP loan, you could not elect to defer any of your employment tax. They've now taken that off the table, and now, regardless of whether you're getting a PPP loan, you can defer the 6.2%.
But those who applied for a PPP loan early on were making their employer contributions based on the rules as they stood. And like my little fantasy world is like, well, I think we should now be able to adjust our withholding, so we defer that for the rest of the year. The fact is you've probably filed and paid those amounts already, and we all know the IRS is still partially shut down, and they had a lack of employees to begin with, right? And so we'll just confuse things, and we'll spend our life trying to clean those up. So even practically, if you could, you're most likely better off to do that deferral on a go-forward basis if you do it. Is that right?
That is right. I have not seen any guidance, and maybe Jim has, but I have not seen any guidance that says that for purposes of this deferral, you could compute what you could have deferred since March 17th that you haven't, and then further increase your deferral based on your current payment. I haven't seen anything that would allow you to do that.
And who would you suggest actually do this deferral, Mike? I mean, the payroll taxes are always hot issues, and the penalties are significant. So at the end of the day, you get a deferral till the end of the year, but at that point, you need to make sure you have the cash and get those paid. So who does this work for, and what are your risks if you, or, it's the employee shares your trust fund portion, and this is the employer share you're deferring, but there's still payroll related taxes which get priority with the IRS.
No, that's correct. They do. And the intent of this, I think, was just to alleviate cash flow issues for employers that are going to be affected by COVID. So if you have a cash flow issue and deferring these payments would help alleviate that cash flow issue, then that would be a reasonable thing to do. But you do have to keep in mind, like you said, Mary, this is a deferral. This is not a forgiveness. You still have to pay those taxes. It's a question of when. So then the when is half of whatever you defer is due at the end of next year, at the end of 2021. And the remaining half is due at the end of 2022. So it's not an insignificant amount of free use of your cash, I suppose, but you do have to keep in mind that at the end of 2021 and at the end of 2022, you are going to have an increased payment because of the deferral. So again, it's designed for people or employers that are in a cash crunch or anticipating a cash crunch, and it will give them some additional cash to operate. But quite frankly, if you're doing okay and the cash flow isn't necessarily an issue, then the question really is, do you want to do that deferral? Because what happens in 2021 and 2022 when maybe the cash flow isn't there for whatever reasons?
Well, let's say I don't have a cash flow crunch, and I just like to earn whatever rate of interest. Can I just set that aside in a savings account and earn some interest on it and then pay it on the due date?
You certainly can do that.
And I mean, it was originally really intended for your over 500 employers, right? So your over 500 weren't eligible for the PPP. There was a lot of exceptions to those rules, obviously, and many employers with more than 500 employees were ultimately able to get PPPs under the various rules. But this was more of an option then. I'm just struggling to find a whole lot of smaller employees, like I just say exercise care about using this particular strategy for cash flow issues, because you're going to have to pay them and you have in line to pay them. So you're better off looking with, since the hardship loans have reopened, that might be what I'd be looking at rather than using this tax deferral.
Yeah, I agree, because again, it is just a deferral and you're going to have to pay it eventually. And, if you're just, if you're not paying it, sticking it into an account or a CD or something that's making you some interest, then, and it just comes right back out to pay those taxes on those dates, that's fine. But, you might be better off, like you said, going for the hardship loan or doing something like that now. And the intent, again, you're right, the intent was to give something to those employers that were over 500 because they weren't eligible for the PPP.
But no reason not to consider kind of setting that aside as an emergency fund and paying it on 2021 and 2022, right? It's like nobody knows where this is going to land. I'm talking to an advisory group yesterday who says, "Oh yeah, this is the shortest lived, economic downturn we've ever had." And the question is that because we've kind of funded it or not? We just don't really know the answers to that yet. So if you wanted to be, just give yourself a little leeway, you could set those funds aside. I just am a little concerned about using those funds when there's other resources to go. But anyway, so the delay is the half at 2021 and half at 2022, right? Year end?
Correct.
And so, and now you can do that even if you borrowed a PPP, which it was the restriction before is that it was kind of a one or the other. So that's opened up a little bit. The credit, I think, might be a little more useful to some people. You want to speak to that?
Yeah, so the credit, different from the deferral, obviously, because you're not deferring this. This is just a straight credit against a payroll tax. So the first thing to look at is whether or not you are an eligible employer. And an eligible employer is anyone that's had basically a shutdown, partial or otherwise, due to a shutdown order. So you have to have
so
that.
What is the partially suspended? I mean, you actually had to be a business that pursuant to the order said, hey, salons, you cannot open at all.
Correct.
What about your medical practice that could only do emergency procedures? Is that like partially suspended?
Yeah, that would be a partial suspension.
And what about businesses who went into the homes of people? And, does that depend on the business type? Let's say heating and air conditioning.
Well,
Did
that
they
would
actually shut
yeah.
down, or was that just people didn't want them in their homes?
Well, if the order actually said, home services business, you cannot go into people's homes, then it would be an order. But if it's just you as the business owner choosing not to do that, that would not be subject to a shutdown order, and that would not qualify you. Now, the next part of this might, which is a 50% loss in income compared to the similar quarter last year. So if you decide that you're going to shut down by not going into people's homes, you might not get in under the first one, but you might get
under the second one. Like you're in a business where, hey, this just isn't safe. We've had businesses who like, wow, this is not safe and we want to take care of our employees and we're concerned, things like that. And so it affected that makes the difference. Right. So it's an or there is the important point. You were subject to it. And you're obviously your states where there is a stay in place order. That's, most places other than essential businesses, right? Nebraska being a little bit different because we had directed health measures.
Right.
But so if you had a decline in 50% of receipts, you're eligible for this credit.
Correct. So once you are an eligible employer, then what wages can you look at in order to determine what your credit is? And it depends on the number of employees. If you have more than 100 FTEs, then wages that you pay to someone who is not providing services, so you basically send them home, they're not providing you services, but you're continuing to pay them, those wages qualify. And that's, again, if you're over 100 employees. If you're under 100 employees, it doesn't matter whether you've sent them home and you're paying them, or they're still working for you and you're paying for them. Those wages will count. So once you've figured out the wages that count, then all the wage per employee is capped at $10,000 of compensation. So you can only include the $10,000 for each employee, and then the credit amount is actually 50% of that, so it's $5,000 per employee.
But we still don't get this if we took the PPP, right?
On this one, you still don't get it if you've received a PPP loan.
Okay, then we do have something, and we have net operating losses, but that's kind of limited to C corporations, correct? Does it apply to anybody else, Mike?
No, they did make some modifications so that other pass-through entities can use the same type of carryback. So it's not just C corporations that it applies to.
Okay, and so what's the value of this provision?
Well, in 2018, they modified the NOL rules so that you no longer were able to carry them back 2 years and then carry them forward, so that you could, if you incurred an LOL in a year, you could basically, apply for a refund for the taxes that you paid in the prior years. In 2018, they eliminated that, and so now it's just to carry forward. But because of COVID, what they did was they said now you can carry NOLs that began, any NOLs that you had in 2018, 2019, or 2020. Now you can carry those back for 5 years. So what that allows you to do is, if you had NOLs in those years that you were only carrying forward and you have any of them left, now you can immediately go back 5 years. And if you have taxable income, then you can use those losses to offset that taxable income.
And the goal was to be able to get taxpayers some cash through the refunding process, correct?
Exactly. If you're in that situation where you had an NOL, it allows you to get some cash by applying for the refund. And the other thing it did was, now there was a limitation on even if you were using an NOL and carrying it forward, your deduction couldn't exceed 80% of your taxable income. So there was a limit on what you could only offset 80% of your income. But what the new rules do for the carryback, it also eliminates that 80%. So you can take it against 100% of your taxable income in those years. So you get just a bigger refund.
And you're talking about how that applies to taxpayers other than corporations. So can you just clarify that? So if I'm a LLC electing partnership tax treatment, can I use it?
If you're an LLC electing partnership tax treatment, then you're not supposed to ask me hard ones, Mary.
Sorry, I like to ask you hard ones.
So if you're an LLC electing partnership tax treatment, then those losses would have carried through to the partners on their individual returns. So I haven't looked specifically at what those rules are as they apply to the pass-throughs, but presumably if you were a partner in that situation, then you would be able to go back and amend your return in order to get that refund.
Right, so we probably need to do some clarification on that. So credits on minimum tax liability?
Yeah, so the other thing that happened in 2018 was the alternative minimum tax for corporations was repealed. But you may have had, if you were a corporation that had some AMT credits that you were planning on using going forward, those suddenly became useless to you because there was no more AMT tax for corporations. But what they did in 2018 was that if you had a credit, you could use that going forward in 2018 through 2021, and you can it's basically refundable against your income going forward. But what the COVID legislation did was it allows the corporations to take the entire amount. If you had an AMT credit, you can take the entire amounts in 2018 and 2019. So basically, you can go back and if you're in that situation and you have an AMT credit, you can go back and amend those returns, and then again you get can get a refund.
And just like a side comment, so we do a lot of year-end tax planning before December 31, right? Because after December 31, 2020, you can't usually go back and make changes. And with all of these different changes, tax planning is at a premium this year. So we're suggesting we usually do that in November and December, but we're going to start pushing for like starting that process in October this year to make sure everybody uses these to their benefit. So then talk to us about the business interest modification.
The other thing that happened, or one of the other things that happened with the TCJ in 2018 was this limitation on interest expense being equal to 30% of the corporation's adjusted taxable income. So there's a limitation on what you can take as an interest expense, and that's 30% of your taxable income. So what the COVID legislation did was it increased that limitation percentage from 30% to 50% for 2019 and 2020. The other thing that it did was when you're computing that 50%, you can use in 2020, you can use your 2019 income as the basis for determining the limitation. So if you had higher income in 2019 because you weren't dealing with COVID, than you do in 2020, you can actually use that higher 2019 income in computing your 50% limitation for 2020. So again, it's trying to get you a little bigger bang for your buck.
Of course, if you sell home fitness equipment or certain other things, then you're probably going to be better off.
Yeah.
Right.
Right.
It's kind of interesting seeing the businesses that are actually doing really well.
Yeah.
The qualified improvement property. So this was just a big issue that a lot of those of us doing tax laws were really whining and complaining about, but they fixed this as part of the process.
That's correct. And again, going back to TCJA, it provided 100% bonus depreciation for certain improvements. One of the improvements was inadvertently classified as 39-year recovery period instead of 15-year recovery period. But everybody thinks that the intent was that should have been classified as 15, and this was just a technical correction of that. So you can, again, it's a refund situation. If you could have taken advantage of that 100% bonus depreciation for that reclassified property in 2018, 2019, then you can go back and amend those returns and as if you got the 100% bonus depreciation and get a refund if that's your situation.
So we think this is a really useful provision for taxpayers. We don't know what their intent was. We really don't care, but we like this for our taxpayers, right?
We like this for our taxpayers who have that type of property, which is non-residential buildings.
And does it apply to tenant improvements too? So if you still have an office, which some people still do.
Any interior of non-residential buildings would be is what it applies to.
Right. So sometimes it's the landlord paying for it, but sometimes that's the tenant added rent. So it's something definitely to look at in terms of your year-end tax planning.
Exactly.
So we're going to switch in the few minutes we have left and ask Matt Dunning to give us an employment update on what's going on in the employment world.
Hello, I appreciate that. You know, what we're talking about right now is returning to work, you know, bringing your staff back if that's what you did during the last few months, or continuing the way things have progressed. I think you just need to rewind the clock a little bit and consider, you know, the different measures that employers took. You know, some never closed down at all. Some kept part of the workforce in the office buildings on site and had others work remotely, and others shut down completely. There were furloughs and layoffs, and some of those furloughs, which is intended to be a temporary thing, may end up being a layoff, which is, you know, more permanent. The opportunity that employers have right now is to break things down and consider what your critical functions are, your essential functions, and determine what needs to happen for your business to keep up and running. So if you think through your workflows, think through the personnel and what the functions are that they were performing and whether or not those are still needed or can be modified, then, you know, there may be some advantages here to streamline and gain some efficiencies.
So yeah, your point, Matt, is like this is actually, you know, with everything negative that happens in life, right? Like, so for me personally, this has been a slowdown that's been really valuable. But here, like, we've really looked at our processes and procedures, and we're hearing lots of employers doing that. It's an opportunity to restructure that include your bottom line. Using the PPP, you're trying to bring employees back, but sometimes it's maybe not a matter of you streamline. We've streamlined several processes and basically automated some things that were being done by employees before. We're hoping to find different roles for those employees versus cutting them, but that contribute to production and revenue production rather than pure cost, right? And that's one of the opportunities of it. So let's talk about briefly, like, most of our employees are very concerned with protecting their employees as they do come back to work. We've had some employers who've opened and then reclosed. I had one client this week who just decided, you know, they reopened and there were a couple issues and they've just decided to permanently close. We're hearing that. We're hearing businesses open and with the restrictions, they're struggling with, you know, being able to remain profitable. So some of your restaurants, they have to serve so many hours, you know, so many meals per hour, things like that. Some are succeeding very well with the curbside business, which I hope stays intact despite, you know, when we get a vaccine, I kind of like the curbside service. But most of our employers, Matt, are very concerned about reducing the risk to employees as they come back to work. So you want to speak to that a little bit?
Sure, and that's part of, you know, adopting a plan that is specific to the workplace. But yes, this slide that you have up is the most relevant to that issue that you're addressing now. You know, if someone is calling in sick, the EEOC has, you know, issued guidance that specifically clarifies that employers are permitted to ask about COVID-related symptoms. If the employee is saying that they do have those symptoms, then the employer can say, well, you are not allowed to return to work. You need to, you know, you may need to take the paid sick leave that has been established. And then, you know, some employers are going to require a negative test before they're allowing people to come back. And I think I've heard recently that some employers, you know, may even require a second negative test.
Especially if there was a positive along the way. So it's like if there was a positive and they think it was a false positive, I think it takes 2 negatives to overcome that, and that's a permissible policy, correct?
Yeah, and that's a, you know, I mean, the issue is employee safety and customer safety. So if there is a positive test, then obtaining a negative test and perhaps a second negative test is what is going to be permitted. Customers coming onto workplaces, into businesses, we're all still private property owners for the most part, and you have the right to refuse service or refuse access as you deem fit. And the same with employees. You want to be able to provide them with the support that is necessary to stay home and not be compelled to come in and thereby spread transmission because they have no choice economically but to continue to work. So that was the intent of the paid sick leave, and those programs are still applicable.
And Matt, I just want to ask one question that has come up a lot, is that every time we have an employer who ends up with an employee who has COVID, the question is always, oh, do I need to tell everyone? And the answer to that's really no, because it's actually, you potentially violate the privacy of that employee, correct? So do you want to just speak to when it would be appropriate to communicate that to others? And we've had others like, should we make a public announcement? Well, a public announcement almost guarantees OSHA showing up the next day, right? If that is an agency that has any. So when and what should, if you do have an employee that works for you that has COVID, what's your obligation?
Well, to report, there's no obligation to report outside of the business, except if there is a work relatedness determination under the OSHA guidelines. But then within, really, it's taking steps to ensure the safety of the other employees, and then if there are customers coming in. The hope is that you can do that without specifically identifying the person who has the positive result. But the reality is, people are going to be able to figure that out pretty easily. People, regardless of whether there's any kind of announcement, if someone is suddenly gone 10 or 14 days, then, the conclusions are going to be reached that there was something going on with COVID. But the ADA does require employers to hold that information confidential, and it's a difficult situation where for the other employees to read between the lines and figure out something that's very very
them
personal.
Figuring it out is employees figuring it out or speculating or whatever. So sometimes, but I think there's this whole thing is that you don't want to communicate like every time somebody gets like, oh my gosh. But the thing is, if there's a risk of a direct contact, things like that, there's potentially some obligations to communicate it in certain situations, but there's definitely not an obligation to make every COVID diagnosis public record, correct? In fact, it's the opposite, and that's worth a phone call or check-in, because we've had people sometimes over-communicate in terms of those issues. What people figure out or guess about is a different thing. But then was there anything else you wanted to comment on just maintaining healthy business operations? I think you had some really good points here. Yeah,
it's important for, to have, the bottom line is, communication. Even at the beginning of this whole process, learning what people are essential, what people are critical, and then basing business decisions on that. As far as identifying a workplace coordinator, a lot of places will have someone who's kind of the bulldog on these issues. They're going to remind everybody of the policies. They're going to be doing the sanitization, or having someone delegated to do that. They're going to be the person that has the supplies, whether it's masks or gloves or bleach water, and everything else that is really being used. Again, the healthy business operations goes down to healthy employees. So again, you want to have the sick leave and the policies that allow people to stay out if they are tested positive or if they are exhibiting symptoms.
And while we appreciate the type A employees who come in and power through anything, if there's a chance that they have it, we really want them to get out of there. And so that's kind of sometimes what we're hearing in some places, like this, one story that we heard this week was the guy who had actually traveled to visit with various organizations, and he wasn't feeling well, but he powered through his meetings and exposed several other people, and 3 of those have now been diagnosed positive. So it's like, encourage your employees, hey, I know you're type A and we love your type A on a given day, but if you have even a symptom, forget the asymptomatic carriers, which we won't go in, that's a whole different issue, right? But please don't come to work, and please, be super careful. And we've gone to saying, hey, we'd, at one point here in Omaha, it seemed like certain populations were getting effective, and it's really easy to get a little lax and impatient and tired of the restrictions. But at the end of the day, any business who has a run of COVID through their workplace is going to risk your profitability. And so keeping those in place, the workplace, this remains kind of important. And I think, we've had calls from several West Omaha professional offices who have had COVID cases recently. It's been a reminder to me, is like, oh yeah, it's not all about the packing plants and the senior living centers. So we continue to need to pay attention to that.
Absolutely. And to your example of the person who's, working through and pushing through and, still coming to the office, it was pretty big news here in Omaha that, there was a county attorney who apparently attended a conference, brought it back, didn't realize it, was homesick a day or two, then returned to the workplace, and, it infected several people, and then, dozens were potentially infected. So, that's just an example. I mean, I think running through all this that employers need to keep in mind is that the Americans with Disabilities Act is really, it does provide restrictions, but it also provides guidance that is helpful. Like I was talking about earlier, making the inquiry of whether or not someone has those COVID symptoms, so that's helpful and is permissible. Here, you may have someone who has, a suppressed immune system, or other conditions that make them more susceptible. If those qualify as a disability, then the employer does have this reasonable accommodation interactive process obligation, because that person has a specific risk, and it may be that the reasonable accommodation that they need is maybe some shields at work, or maybe an enclosed office on a temporary basis, or even working at home. And what employers are finding is, really, are your employees who are working at home, are they going to be able to do that effectively? Are they going to, even if they are effective, are they actually going to do it? I've had an employer who checked the logs on one of their people who was working at home, working remotely. And, she hadn't checked in more than 3 or 4 days in 6 weeks. So, they hadn't paid her because, she wasn't reporting hours. Actually, she did report some hours that she hadn't worked, so they didn't pay her for that. So anyway, that was an easy way to end a relationship that, that person was not a high performer already. So there are some.
That is what we're hearing, like where we're not seeing so much. And I'm just going to, if you have one last final comment, Matt, because I ran a little bit late just because we had some technical difficulties here, but sure. I want to wrap it. But so what we're seeing is, that there's companies not doing COVID layoffs, but there's also opportunities if you have employees who've been long-term problems. Because we are hearing, there's some of the remote work may be a part of the workplace for the future. You should have definite workplace policies in place so that if you have that employee who we've heard more than once about somebody like logging in on their phone and then rolling over and going back to sleep as opposed to working and things like that, you want to make right. sure you're positioned to not violate any rules, to make terminations when appropriate, because hey, there may be instances in the future, we just don't know, where you may need to send part of your workforce home, or I've heard companies after the recent spikes who've decided to delay dates of bringing more employees back in. And so you do want to make sure that you have the policies and processes in place. Did you have a last comment before we close, Mike? Matt, sorry.
Yeah, sorry. No, that comes down to, clear policies, clearly communicated, establish expectations. When you come down to a termination decision, always have, a thorough investigation and not jump to conclusions regarding any particular situation. Those are general pieces of advice, but they are all, they all come under the microscope at a time like this because there are so many more people affected. So
and I am going to ask one last question, Matt, just because I get asked this one a lot in case this is of any value to any of our listeners. But so there's been the whole issue with the school closings and people uncomfortable sending kids back to daycare, and that's affecting a lot of productivity at home. What are you supposed to do if you have an employee at home with kids and it's affecting their productivity? Can you set restrictions on that?
Well, I think, a lot of employers are establishing that, the employee needs to have a separate workplace that has a lock on the door to protect confidentiality, things like that. At the end of the day, if the person isn't able to maintain productivity for whatever reason, then the employer retains the discretion to make decisions on that basis. At the same time, if the employee would be able to maintain a normal work schedule, or not a normal work schedule, but a normal level of performance by having a modified work schedule, then that presents an opportunity for the employer to work with the employee if they are otherwise a productive person. So you might have an early morning and then an evening schedule if the type of work permits that. I know of one situation where based on mainframe availability, people are being assigned from 7 p.m. to 2 a.m. to do their work. So there
are a lot of solutions. You don't have to tolerate poor performance, and
Correct.
You can require that people, if they want, are going to work at home, you can require productivity, and you can terminate accordingly, but you need to have the policies. Well, thanks, Matt, Mike, Jim. Jim's going to send out some documents to anybody, and feel free to send us questions. Thanks for participating today, and have a great day.
Thank you, everyone.
Thanks, everyone.